Good morning. Welcome to our webinar, The Living Portfolio, a Logical Approach to Containing Your Investment Risk. I'm Scott Bussey with Bearing Financial. How to contact me on Twitter and in my office. I want to cover a couple of housekeeping items before we get started. This is designed to be a 30-minute presentation. If there's an interruption in transmission, go to the browser window and click the refresh button, which is the clockwise circular arrow, to refresh the screen. If for some reason the transmission is interrupted, okay. Sorry for this interruption here. I didn't realize that you wouldn't be able to see the material that we're putting forth. Bearing Financial Advisors, this is my biographical information as well as my Twitter handle. This is a way to contact us after the presentation. Again, housekeeping issues. If we are interrupted in transmission, just click the browser refresh button, which is the clockwise rotating arrow sign, and that will refresh your screen to the point where it left off. If, however, you cannot restore by refreshing, we will try to furnish you access to a webinar's replay if you'll contact us at these locations. If you receive a very short survey request from Laura Donahue after viewing this webinar, please know that we greatly appreciate your responses. We plan to continue to educate our clients, financial advisors, and investing public, so your survey comments will help us deliver the most useful content. I want to say before we get started that securities and advisory services are offered through VSR Financial Services, a registered investment advisor and a member of FINRA and SIPC. Bearing Financial Advisors is not owned or controlled by VSR. A little bit about Bearing Financial Advisors. Our practice was originally founded in 1997 based on serving institutional as well as retail clients. We evolved towards tactical money management, focusing just on retail-only investing clients and financial planning clients. We initiated study of investment risk management. Today, we pride ourselves on managing factor-driven, stock-based investment models, as well as tactical investment accounts covering 5 different major asset classes, well, 6 including alternatives, and our specialty is tactical risk management. I want to begin with a story from a book entitled Why Smart People Make Big Money Mistakes by Gary Belsky and Tom Gilovich. By the 3rd day of their honeymoon in Las Vegas, the newlyweds had lost their $1,000 gambling allowance. That night in bed, the groom noticed a glowing object on the dresser. Upon closer inspection, he realized it was a $5 chip they'd saved as a souvenir. Strangely, the number 17 was flashing on the chip's face. Taking this as an open, he donned his green bathrobe and rushed down to the roulette tables, where he placed the $5 chip on the square marked 17. Sure bucks. He let his winnings ride, and once again the little ball landed on 17, paying $6,125. And so it went until the lucky groom was about to wager $7.5 million. Unfortunately, though, the floor manager intervened, claiming the casino didn't have the money to pay should 17 hit again. Undaunted, the groom taxied to a Better Finance casino downtown. Once again, he bet it all on 17, and once again it hit, paying more than $262 million. Ecstatic, he let his millions ride, only to lose it all when the ball fell on 18. Broke and dejected, the groom walked the several miles back to his hotel, where his wife was awakened at his arrival. "Where were you?" she asked as he entered the room. "Oh, playing roulette." "How'd you do?" "Not bad. Lost $5. This story of the man in the green bathrobe is known by casino pit bosses, but now renowned by behavioral economists because it deals with a bedrock principle they refer to as mental accounting. Because our newlywed started his evening with just $5, he's felt like his only loss was limited to just that amount. This illusion of playing with the house's money plays as much a part in why casinos make so much money as the odds that favor them to start with. Other illusions that innately work against the individual come from our cognitive biases as a result of wiring, the neurology of our brains, and the predispositions we have to under or overreact to things like investing in the stock market, according to studies in the field. Here are some examples. Asymmetrical response to gains and losses. In other words, the emotional intensity of losing trades is twice that as winning trades. The disposition effect describes where investors sell winning stocks too soon and hold losers far too long. Decision paralysis, and countless more behavioral-rooted inclinations that affect and impede our ability to remain rational about our own investment portfolios. The Living Portfolio is the title to our presentation, and you might think that that's a strange title for a webinar investing, but my hope for you is that by the end of this presentation, you'll come to appreciate that similar to anything else we rely on for sustenance, like a home, food, a job, personal relationships, a nest egg, we need to commit time, attention, and caring to our investments as though they're going to fulfill our expectations for them. You see, neglecting them has consequences, and so do emotion-based decisions when it comes to investing. A really logical system, a well put together system can help you. So the goal of this presentation is to equip you with the awareness and know-how you need to begin to use the system tomorrow that will help you address risk and invest more confidently. We'll begin to explore the logic of our systems-based approach by talking about investment risk. What is it? How is it managed? Who will manage the risk? And what a systematic approach to managing risk would look like in the form of the DREAM system. So first we'll begin by examining investment risk and answer the questions: what is investment risk? How does it threaten the outcome? And how we can address that risk. Our choices so far, how we've been addressing it, or based on how we have been addressing it, are grin and bear it, which is also known as the buy and hold theory. How about avoiding it? Remember, no risk, no return. We insure it. Now that has its limitations, both cost-wise as well as effectiveness. How about being adaptable to it? Does that sound interesting to you? Let's see now how our industry defines investment risk. FINRA states that investment risk is synonymous with systemic or systematic risk, and that risk, they point out further that diversification among risk-on or just growth assets, those asset classes alone, will not work to dampen the amount of risk a portfolio is exposed to. They say the only real defense is to invest in fixed yield, fixed maturity assets like CDs and bonds, maybe corporate preferred stocks. And after 6,000 words of circumnavigating the subject, FINRA finally admits that modern portfolio theory, also known as the buy and hold strategy, is the industry standard for dealing with investment risk. So here's the question I want to pose to you. Does a one-size-fits-all approach seem like the right way to deal with each and every client's unique financial makeup? There's a variety of risk categories that affect a client's portfolio, and here I've listed some that are quantifiable, while others will play themselves out in more uncertain, less clear ways. The first one is cognitive biases, and this describes the baggage that we carry in terms of the psychological baggage we carry in regards to how we carry our expectations or hopes for favorable or fear of an unfavorable future outcome. Inflation. Now, it might be a whole entire portfolio that can't keep up with inflation. What this poses to us is in effect a negative real return after subtracting the corrosive effect of inflation on the performance of an underlying while inflation is running at 2%, producing a negative real rate of return of negative 1.5% in lost purchasing power in that portfolio. The next risk is called timing risk, and it's also considered point-in-time risk, as well as referred to as sequence of return risk. This focuses on the likelihood of negative events or a series of negative events occurring at the wrong time, like a down market over the early years of someone's retirement, or a black swan event like what we saw in the stock market in years 2007, 2008. A black swan event is an event that deviates beyond what's normally expected, one that's not readily expected, one that produces outcome that's not beyond the normal expectation, and thus it changes our perception of realities moving forward. Well, that might lead to the next risk that's listed here, which is situational decisioning. And this refers to how we change our tolerance and our outlook, and thus our decisions based on prior year's performance. We're essentially letting emotion win over our rational, logical capacity for thought. And finally, portfolio failure risk, also known as excessive withdrawal risk, occurs where investment performance is insufficient to keep up with a portfolio depletes its asset base due to withdrawals continuing to be made by the retiree without adjusting for subpar investment returns. So let's proceed now with our process of understanding what risk is and how to manage it. Risk management is defined in Wikipedia or Investopedia as the identification, analysis, and acceptance or mitigation of uncertainty in investment decision making. So if we break that down, we're going to identify and analyze the risk of uncertainty. This of uncertainty, we'll consider whether to accept it. So in essence, uncertainty is the risk. Will the market move up or down? If it does, to what degree? And for how long will it move in that direction? That's what's uncertain, and the outcome is what we have to deal with. And finally, by the end of this presentation, you'll be able to put your own brand of investment risk management to work based on this study. So the next slide gives us a basis to quantify the magnitude of that risk. In other words, how bad can it get? Here we see some investment research, very useful investment research provided by Ned Davis Research in 2012, taking us over a period of greater than 84 years, where we see the market's corrections categorized into these 4 different columns. I'm going to focus on the severe correction, which is the second from the right, and the bear market correction, which is the furthest one to the right, that show corrections of 15% or more or 20% or more. Based on history since January of 1928 through April 9th of 2012, we see that the severe correction of 15% or more occurred 43 times, an average of every other year. Had a mean duration of 191 days or more than 6 months' time, and a mean decline of 28.2%. A bear market, which was a correction of greater than 20%, occurred every third year, had a mean duration of 299 days or nearly 10 months, with a mean decline of 35.7%. Obviously, this is an event we want to try to address here. It's these kinds of corrections that we want to try to limit the degree to which we're negatively affected. So let's see how this severity degree and length of time will affect the overall portfolio. What we see here is a 20% drawdown, or a drop in the value of a portfolio by 20%, will require a greater than 25% return just to reach its break even. A 25% loss would require 33.33% return just to get back to break even. There's the formula that you can copy down to use this as a means to determine or examine more closely what one's risk tolerance level is, and so you can make an informed decision as to whether or not you want to do something about it. Another way to look at this would be by taking a calendar year past, the actual past, where we can view an actual decade of investment performance to see how magnitude, timing, and recovery percentages come into play. So imagine a couple retiring on January 1st, 2001, and for their investments in stocks, they and their investment advisor expect a return of at least 7% compounded annually over that 10-year period of time. So they're expecting some years of greater than 7%, some years of less than 7%. And if they averaged 7% compounding annually, they'd wind up with $196,715 if their portfolio was $100,000 at the start. So how did it go? Well, we got some good news and some bad news. Good news is, out of those 10 years, we had 7 up years and only 3 down years. The bad news is, due to the fact that 2 of those 3 down years occurred in the first 2 years, and the degree to which we saw negative rates of return of -9 and -22%, the portfolio really never got started. Beginning at $100,000, it ended the decade at just $116,729, just a gain of $16,729 or 1.67%. That's far short of their 7% expected compounded return, so it's actually a difference of nearly $80,000 or 8% raw over that period of time. To add insult to injury, if they had just kept their money in money market returns, the portfolio might be worth $123,000. So here's my question. After looking at the depth, severity, expected time periods, and an actual decade in comparison, do we want to accept this kind of a risk, or do we want to explore steps to mitigate or at least reduce our exposure to that risk? You see, this portfolio didn't show a whole lot of life over this first decade, and the odds are it's going to take some serious investment acumen to try to recover that period of time. More so if they were actually spending out of this portfolio throughout that time period. Can we come up with a plan to avoid this from happening? Do you have a contingency plan for when things break down? Seriously, the question should be examined here. How should we approach building a plan to manage investment risk? So let's begin by establishing a few absolutes as guiding principles to managing investment risk. The first one is proactive management is better than reactive. Simply stated, it's better to have a plan and not need it than not need a plan, or need a plan and not have it. Second one is responsibility is not limited to the investment manager. Just because you farmed this money out to a third-party money manager, happy, concerned to the degree that you would like to make some changes in your diversification, but diversification across stock assets and stock mutual funds is not the answer. Finally, if you can't assess the risk of a particular investment, you just shouldn't own it, or else admit that you're a speculator, you're not an investor, and think seriously about reducing the size of that investment so that it doesn't weigh down the overall portfolio if it underperforms your expectation. And at Bearing Financial Advisors, we add one more step to this. We agree with the view that a risk management framework should be aligned with the client objectives, expectations, and investment horizons. You see, we actually believe that each portfolio should reflect each client's own personal circumstances. So our framework is built on a proactive, quantifiable, and systematic system. It's called the DREAM system. And here's model downloads market data nightly, more than 36 market data elements fed into 9 key indicators, 3 long-term, 3 middle-term, 3 short-term. Based on the updated data, 9 key DREAM indicators are coded according to risk classifications. Based on these classifications, the model will then prescribe to us any one of 4 settings to cap the level of equity investments that we hold. The 4 different levels are 100% or full offense, 25%, which is full defense, and 2 positions in between, 75% offense and 50% offense. These percentages are percentages of the client's maximum exposure level. So 50% of it, 50% level, DREAM system level, for an investor that is capped at 80% equities, would indicate that we would be running that client at 40% weighting in equities at that time. So for the sake of today's discussion, let's focus on one of the DREAM systems indicators called bullish percent. And bullish percent refers to the percent of stocks within a given universe that are on a buy signal. For example, if 450 of the S&P 500 stocks are on buy signals, then the bullish percent for S&P 500 stocks is 90%. 90% are on buy signals, 10% are on sell signals. We use the bullish percent for measuring risk and measuring the competing strength between supply and demand for stocks at a given point in time. So let's take a look at a trend chart for the bullish percent for all New York stock exchange, how it's tracked. Here we see the bullish percent with the bullish percent point and figure chart showing hash marks indicating the years of 2007, 2008, 2009, and 2010. The X's show moving up, the O's show moving down. So what we see here in reality is a point in time of October 2007, in fact, when 62% of the stocks in the New York Stock Exchange were giving off buy signals. The S&P was at 1562 at that point. We see that moved downward prior to October. It moved back up, peaked at 62%, only to move back down again. Demand, the New York Stock Exchange dropped, in this case, down below 16%. If we were to follow no other indicator, the bullish percent for New York Stock Exchange stocks would have been indicating to us that we needed to lighten up our exposure in equities, such that in October of 2008, we see that only 4% of the stocks were giving buy signals, or 96% were giving sell signals. The bullish percent dropped to 4%. The stock market dropped greater than 46. In November, we saw that reverse all the way back down to 14%, a higher bottom, yet the S&P 500 dropped even further from 840 to 680, bringing the cumulative drop to 56% negative. So your stock portfolio, if you've stayed in the portfolio during this period of time, would have lost roughly 44% of its value. My guess is that there would be some pretty emotional moments experienced during that period of time, and I won't embellish. But I will say that the higher bottoms here indicated to us that October was the bottom in terms of bullish percents, November was a better month, and in March of 2009, when the market hit rock bottom, it was 666 intraday, we were seeing higher bottoms and taking a signal by such that within a week's time the dream system was telling us to increase our equity level. So while people were bolting for the door, we were in fact beginning to push money back into equities. That's the irony of this system, which was inspired to save our clients from financial risk. It actually told us that we needed to move into the market with confidence at a point in time when other people were making the opposite maneuver because the headlines were telling them to do so. So my question for you is, will you take any measures to set yourself apart from the crowd? Consider setting yourself apart by using a logical system that addresses equity investment risk to keep your investment portfolio viable by adjusting your exposure to that risk. Our plan's the dream system. Look, no system's perfect. When the dream system isn't right, it's going to correct itself to get back on the right track. It's not market timing. It's non-predictive. It's trend following. It systematically measures the changing risk levels in the equity markets, and it recommends corresponding limits to which we'll be exposed to that risk. It's not based on emotion. It's now, I promise you that you'd be ready to put the dream system to use in your portfolio or your book of business if you're a financial advisor before we wind this up. So let's see how that might work. This is a diagram that I constructed to help you understand the principle of not controlling risk, but controlling your exposure to the risk. What we have here on the X column, the horizontal column, are TMA 5 through 10. Those are tactically managed accounts where the client is allowed to own as much as 5% to 100% in equities. These are different clients adhering to different models. TMA 7 investor is an investor that might own as much as 70% equities at full offense or a bull cycle. At 75% offense or bull one investor down to 52.5%. At Bear Watch, or 50% offense, we'd go from 70% to 52.5% to 30 to 35%. And then down to 17.5% when we're on full defense, which is also considered bear cycle. So the steps that we take in managing our book of business follow 4, maybe 5 different points. The first is determining the risk tolerance of a particular client. The second would be to establish that maximum risk level, or what we call a TMA code. A TMA 7, a TMA 8, a TMA 9 would be a 90% equity investor during the best of times. The third step we take is to determine whether or not the client would like for us to apply active risk management steps to their portfolio. That's a simple yes or no answer. If they want us to employ active risk management, we'll use the DREAM system to guide that portfolio. The fourth step is to manage those equity levels according to the DREAM system updates, which are fed via Twitter or our website homepage. That gives us not just what the DREAM system level is currently, but what the reasons are that substantiate our movement to that level. The fifth step is optional, but we use it for most of our client base, is that we tactically manage accounts ongoing to periodically stay within the strong relative strength asset classes and avoid the weak ones. So by now you might be asking yourself, how many times, how frequently do these DREAM system level changes? Do they levels change? Well, in 2012 we saw a very active year. It changed 13 times throughout the year. That was a very difficult year for tactical investment managers. In 2013, however, it changed just once. In January of 2000, and stayed at 100% full offense the balance of the year. In 2014, we've seen 4 changes so far. We currently sit at 75% offense. Now, this picture here is intended for you to envision how you might manage your portfolio, how you might manage your book of business if you're a financial advisor, or how you might just manage certain segments of your investment book of business, namely 401k allocations, annuity allocations, and rebalancing. We use the DREAM system during our conversations with the client about setting up a policy statement for their investment policy. Do you want risk management to be employed, yes or no? New client acquisition conversations are always lively. We get the inevitable question, okay, what are you going to do if the market goes off the cliff? Our standard answer is to point to the DREAM system as our independent, unemotional, logical, objective reference point, which systematically checks the changing levels of risk in the marketplace and prescribes the extent to which we'll be exposed to it. Clients want to know that we have a plan, and they can sleep well at night in knowing so. We also use the DREAM system to guide us when we're adding new investment dollars to existing portfolios. The brokerage account management platforms that we're on include at least 2 different platforms, and we have systematically applied the overall risk management program to manage those portfolios for investment risk. Now, there are many more ways that you can take an independent concept such as investment risk management and apply it to your portfolio based on your concerns, your focuses, your priorities, and the priorities of your clients and your constituency. You see, since 2007, our mission's been to save our clients, our friends, and our family from financial ruin by keeping their portfolios alive, keep them thriving. I want you to know that if you have any questions about how the DREAM system can help you, I'm here to help. Happy to discuss our experiences, our approach, what worked well, what didn't work well. If you decide you want to check periodic DREAM updates for level changes, you can refer to Twitter handle @TheDreamSys. You can see my periodic updates on Twitter, my commentary at @ScottBussey. Feel free to email me. Check our Bearing Financial homepage at bearingfinancial.com for DREAM system updates and the rationale for making those changes. I want to thank you for being part of it, of predicting major corrections when Fed intervention and artificial monetary support ends. Will we need to know what will happen then? The short answer is no. We just need to have a guidance system to show us how to respond to those changes. I can coach you through investing prudently, keeping your investments alive, I'm happy to do that, share everything I have with you. Thank you again for watching. We appreciate you joining us today.